Good morning, everyone. A very warm welcome to the monthly direct taxes updates organized by Taxguru and TaxCut. Further, I will to introduce our speaker, Mr. Vivek Jalan. Mr. Vivek Jalan is a qualified chartered accountant, qualified LLM and LLB. He is the chairperson of the Indirect Tax Core Group of the CII, and he is the chairperson of the Fiscal Affairs Committee of BCCI. He is a regular speaker of various professional forums on the key area of direct and indirect taxes. Now I would like to introduce our another speaker, Mr. Rishabh Jain. Mr. Rishabh Jain is a qualified chartered accountant, qualified CFA. He is a regular speaker in various sessions in various Chamber of Commerce. During the session, please put your video and microphone off. If anyone has any query, please write in the chat box. We will answer all your queries at the end of the session. Now we request our first speaker, Vivek sir, to take the session to forward. Thank you.
Thank you, Titli. Am I audible?
Yes, sir. Yes, sir.
I'll just share my screen. Yeah. Is the screen visible, Titli? Is the screen visible? Okay, visible. So, thank you all for joining this monthly webinar on direct taxes. Again, we have been doing it since some time, but this series we have started from last month onwards. And we will discuss a host of amendments and issues in the direct taxes in the last month, issues which are regularly being dealt with by the taxpayers and which have been brought to our notice. Some new schemes in income tax which have been announced in the last month. And of course, the cat and mouse game under section 148, which has somewhat been brought to rest by the apex court's judgment in the case of Ashish Agarwal in the last week. So while 148 and of course this ITR-U which has come will be taken by my co-speaker Rishabh, and I would be taking on the other issues and amendments changes in the last month under direct tax laws. Friends, see, first issue which we have dealt with specifically, over a period of last 6 months or so. And this is an issue whether to deduct TDS, not to deduct TDS on CHA payments, and how should CHA report the revenues and the collections in their books of accounts. This is applicable in other businesses also where you take reimbursements from your clients, right, or customers. So we will discuss this holistically, not only related to a judgment which has been pronounced by the Honorable ITAT. Now let us understand the transaction first with the means of an example, and thereafter we will come to our suggestions on to how to structure and report the transactions in the best way so that there is no liability under income tax. Also, we will discuss a little bit on the GST angle because this is a holistic transaction. We have discussed this in our indirect tax colloquiums earlier in the other forums. So let us take an example. Say you are an importer, you are company A, which is importing certain materials from a foreign country. You have to pay a shipping line and you have to pay for terminal handling charges also to a terminal handling company. However, you have appointed a clearing and forwarding agent who makes the payment, clears the goods for you. Thereafter, the clearing agent takes his fees for C&F as well as it takes the reimbursements of the expenditure which it has incurred on your behalf. So, the shipping line charges freight of 1 lakh rupees plus 18% GST, 1 lakh 18,000. The invoice of the shipping line is in the company's or the importer's name, say A. The GSTIN number also is of A. The clearing and forwarding agent pays 1 lakh 18,000 to the shipping line, clears the material. It charges 10,000 rupees as its service charges. On that, it charges 18% GST. The clearing and forwarding agent gives two bills to the importer A. One, its service charges with GST, that is not a problem. The other, it gives a non-taxable invoice of 1 lakh 18,000 rupees, non-taxable under GST. The shipping agency or the shipping line makes this invoice directly on the importer. The importer takes the credit of that invoice. However, it devolves the payment of 1 lakh 18,000 rupees to the clearing and forwarding agent who had actually paid on behalf of the importer to the shipping line. The question is whether the importer A would deduct TDS on this 1 lakh 18,000 rupees or not. Okay, voice is breaking up. Uh, is it fine now? Avik or from Tax Connect, somebody?
Fine, it's fine, it's fine. It's not breaking.
Clear. Now, the now let us come to what to do. Now, first of all, the most important thing to see is whether this shipping agency charges or freight or terminal handling charges, is it liable to TDS or not? The answer is in the affirmative. TDS is applicable on this terminal handling charges or freight charges. Therefore, it is mandatory for the importer to deduct TDS on these charges. However, the question is whether the C&F agent has deducted the TDS on these charges or not. If the CHA agent has deducted TDS on these charges while paying to the shipping line, then no problem, the importer may not deduct the TDS. But if the shipping agent, the C&F agent has not deducted TDS, which by and large it does not deduct, then it is mandatory for the importer to deduct TDS on these charges. However, If there is a TDS exemption certificate, then let the CHA produce the C&F, the TDS exemption certificate, and you can not deduct the TDS on the same. The question is, what is the liability of the CHA? The CHA, even if it does not deduct the TDS on the due to the TDS exemption certificate under section 197 produced by the shipping line or the terminal handling charges agent, it has to still report that in its TDS returns with the exemption certificate number. Now, this procedure is somewhat circumvented many a times by the CHAs. They do not deduct any TDS. Sometimes the importers also do not deduct the TDS on the CHA payment. However, in case you are assessed by the income tax authorities, then you as a company may lose out on this expenditure, and this expenditure may be added back due to non-deduction of TDS on the amount. Therefore, we suggest always that the importers should deduct TDS on the payments made to the CHA agents in these transactions. The question in the current case was that the CHA agents in the case of Distributors India did not deduct the TDS on the payment to the shipping line. However, the client importer in the instant case deducted the TDS while making the payment to the shipping agent, even on the reimbursement for the freight shipping line or terminal handling charges. The CHA did not at all disclose this entire transaction in its books of accounts. It netted off the receipts against the expenditure. However, in its 26 AS, the TDS deducted by the client reflected, and that became a ground for reopening of the assessment. The question before the Allahabad High Court was whether this information as per 26 AS of the CHA could be a ground for reopening of the assessment, which was answered in the affirmative. Therefore, friends, if you are a CHA, CNF agent, it is important for you to deduct the TDS and report in your TDS returns. If you are the importer, you have to ensure if you get a surety that the TDS has been deducted by the CHA agent, only then you may not deduct the TDS. However, if you do not get a surety, then you have to deduct the TDS to be on the safe side. The question again under GST in this case is whether this receipt should be disclosed in your GST return. Well, I will not go into the nitty-gritties. We have discussed this several times. We can discuss it in our indirect tax colloquiums, which we have monthly also. But it is our advice that there are 6 types of supplies in GST. This reimbursement in the nature of pure agent is in the nature of no supply. There is no place to disclose no supply in GSTR1. However, no supply is to be disclosed under GSTR9, and therefore this amount has to be disclosed in GSTR9 as no supply, so as to inform the GST authorities of this transaction and to avoid any allegation of suppression, etc. Friends, GST we discussed in our last monthly direct tax updates on the various amendments in ITR-1 to ITR-6. ITR-7 was notified a little later, and we will discuss on the major amendments in ITR 7. While apparently you would see that there is no major amendment yet, there have been certain changes in the ITR 7 which are facilitative of correct disclosure and which would require charitable organizations to disclose further facts and figures and to prepare and be ready with these facts and figures before filing of ITR 7. First, for corpus funds, there was no place to disclose the movement in the corpus funds. Say, for example, you are a hospital registered under 1023C, or you are a temple, or you are a chamber of commerce registered under 12AA, 12A now, enjoying exemption under section 11. However, you have certain specific donations for a building, to make a building, that is in the nature of corpus donation. There was no place to disclose the movement in the corporate donation. How much was the opening figure? How much was utilized, further received during the year? How much was utilized, and how much is the closing corpus fund? Now that has been introduced in ITR 7. Another important, very important disclosure which was not there, I would say it is a welcome disclosure, because this was creating a lot of confusion, and while assessments, it was required by the ITOs and it was difficult to convince them. You see, even capital expenditures are to be considered in the utilization of the receipts for the purpose of section 11 or 1023C, whatever you might call it. Now, section 11 and 1023C, after the amendments in the 2022 budget and 2022-1 budget, they have been all bought at par with each other. So, for the even the cap, now in section 11, you are duty bound as a charitable organization under 215 to utilize at least 85% of your total receipts in a particular year. Only 15% you can accumulate and carry forward. However, if you do not utilize that 85% in 1 year, you can carry forward the balance for 5 years, but in a block of 5 years, you have to utilize at least 85% of your total receipts. Now, this capital expenditure was also a part of the utilization. And if you have taken a loan for the purpose of any capital expenditure or other expenditure, then the repayment of the loan would be considered to be the year of the utilization. For say, for example, you have taken a loan for purchasing a particular furniture. The date of purchase of furniture in that case would not be considered to be as a utilization for the purpose of calculating this accumulated 15%. The date of repayment of the loan would be considered to be the date of the utilization for the purpose of calculating this 15%. There was no place to disclose how much of the loan was opening, utilized, closing, and correspondingly how much from the loan was added to the utilization. Now there is a specific table to disclose this, which is again a very important and a useful amendment to the ITR 7. You see, under 11, section 11(5), you can make certain investments. You are not allowed to make certain investments. For example, you cannot invest in shares, etc. However, there was no place to actually disclose what is your investments during the year or what are your opening and closing balances. Now there is a specific place for that, and so that the investments, whether or not it is in compliance with sections 11(5), can be tracked. Again, there was no place to disclose how much is accumulated during the year, how much has been carried forward, etc. for the purpose of this 15% accumulation for charitable institutions under 2 subsection 15. Now there is a specific table to disclose this. So these are the 4 important amendments in ITR 7. You can go through this and relate it with your ITR 7 when you're going through the forms. But important is to prepare your organizations. If you are a practicing tax professional, to prepare your clients that, gentlemen, these are the amendments and these are the additional requirements for ITR 7 filing from now onwards, because generally charitable organizations, they take time to prepare the data and becomes a Herculean task. Next important amendments is an e-dispute resolution scheme for small taxpayers. Now this is a very important and a very beneficial scheme, since it is an electronic scheme for small taxpayers, and I would say even for NRIs. It is a very good opportunity to settle your disputes electronically in the nature of faceless assessment only, you can say, without going to the tax office at all. For tax consultants, it is a good opportunity to settle the small cases of your clients which come under this dispute resolution scheme. So this scheme is applicable for almost all types of assessments, reassessments, TDS notices, TCS notices, TDS, TCS assessments, even dispute resolution panel 144C orders. You can go against go for this scheme. However, it is not applicable for those assessments which are done apropos 132, 132A, 133A, search, seizure, requisition of books of accounts, and survey. So if you have been assessed as a result of survey, search, seizure, you would not be eligible to go for this scheme. Otherwise, even 148 and all other kinds of assessments, reassessments, orders, appellate orders, by and large, everything is covered under this scheme. It is applicable only to those taxpayers who have a returned income in the relevant year for which you want to go to the for the DRP of not more than 50 lakhs, and the dispute for the relevant year for which you are going for the e-dispute resolution scheme is not more than 10 lakhs of rupees. So what do you do for going for this dispute resolution scheme? You have to file form 34BC. It will be an online form, but only today morning I was going through the income tax portal, but the form is not online as of now. A dispute resolution committee having 3 members would be set up. They would be retired commissioners who have more than 5 years of experience, etc., etc. You can go for dispute resolution scheme within 1 month of the order date or within 1 month of forming of the dispute resolution committee, whichever is later. Now, once you go for this scheme, you file form 34BC. We will come to this form 34BC. Few important points in 34BC. So once you file for this, the dispute resolution committee, either it can accept it, and within 6 months from the date of acceptance of your form, it has to pass an order for settlement of the dispute. However, if it does not accept your form as it is, then it can issue you a show cause notice. show causing you as to why your application in Form 34BC should not be rejected. Now you reply to this within 1 month, and thereafter within 6 months, the Dispute Resolution Committee has to pass an order. However, the most critical point in this e-dispute resolution scheme is that no order can be against the taxpayer, right? So no order can be against the assessee. It cannot be prejudicial to the interest of the assessee. So that is an important criteria. If you feel it is prejudicial to to your interest, then you may not go ahead with the order of the dispute resolution committee. Hence, it is a win-win situation for the small taxpayer when you're filing Form 34BC. It has to be with a fees of 1000 rupees. This is the Form 34BC, right? So you have to enter your KYC details, personal information. Then you have to file the details of the order against which your application is being filed, right? So date of the order, date of service of the order, and income tax authority passing the order. Table number 4, you have to disclose the application details. How much was the income assessed? It should not be more than 50 lakh rupees. How much was your addition? It should not be more than 10 lakh rupees. In case of loss, how much was the total disallowance? Again, should not be more than 10 lakh rupees. Total disallowance is there also, addition is there. The disputed amount should not be more than 10 lakh rupees. And amount of dispute, maybe you accept some amount, maybe you dispute some amount. So your disputed amount should not be more than 10 lakh rupees. Table number 5, you have to disclose the application details which have been pending with the DRC earlier. Table number 6, details of taxes paid. Table number 7 and 8 and 9, these are important. Here you say statement of facts. In brief, it should not be more than 1000 words, etc. Grounds of application should not be more than 100 words. However, you can attach and elaborate grounds and facts and the documents which you wish to rely upon. And you give your application fees details, etc. and you can go ahead and file it. This would be a completely online process. The order of the DRC or the show cause also would be an online process. So this was notified on notification dated 5th of April. You can go through the notification at your own pace. And once this DRC is set up, the form is made online. You can go ahead with this e-dispute resolution scheme for small taxpayers where the returned income is not more than 50 lakh and the disputed amount is not more than 10 lakhs of rupees. Now, friends, very recently, I think on 11th of May, the circular was issued for compulsory scrutiny cases. This circular was issued with two motives. First is that as per amendment in Finance Act 2021, 143 two notices have to be issued within 3 months of the end of the relevant financial year. So by 30th of June 2022, you have to get the notices for the assessment year 21-22. Now, if it is a case of compulsory scrutiny, there are 9 cases which are listed in this instruction. If you fall under those 9 cases, then there are 2 categories broadly. Either you can be assessed and the scrutiny can be done at your range, or it can be forwarded to the central processing unit or the national faceless authority. So first case is, if you have been surveyed in the previous assessment year relevant to a previous year, then you will fall under compulsory scrutiny, but there are three exceptions. If you have not retracted from the statement given by you at the time of survey, you would not be liable for compulsory scrutiny. If your return income is not less than last previous year, last assessment year, then you will not be eligible or liable for compulsory scrutiny. This is a very interesting ground. This gives a hint also as to when a survey may not come. If your returned income falls drastically below the last returned income, then your survey might also come. Therefore, now if your returned income is not less than the last returned income filed by you before the survey year, then even you are not liable for compulsory scrutiny. This is a very interesting and important point. And if your books have not been impounded during the survey, then you are not liable to compulsory scrutiny. The compulsory scrutiny in such survey cases would be done by a central charge with the permission of the principal CIT or principal DIT or DIT. Such cases would be forwarded to the central charge within 15 days of the notice under 143(2). A list has to be prepared by the AOs, and the list has to be with the permission of the principal CIT, principal DIT has to be forwarded to the central charge. Cases pertaining to search and seizure, again they are liable to compulsory scrutiny. Same, they would be forwarded to the central charge, not assessed at the range level. However, where you are not liable to go to the central charge, then you would be liable to be scrutinized at the range level. Next, 142(1) notices. If you have filed a return consequent to a 142(1) notice, then no compulsory scrutiny. However, if you have not filed your return of income consequent to 142(1), then you would be liable for compulsory scrutiny. And the same would be forwarded to NFAC, right? National Faceless Center. Okay. Very, very important point. While forwarding the case to the National Faceless Center, your assessing officer has to upload on the ITBA the documents on which he has relied on to issue 142(1) notice. So this is a very, very important point. Rishabh would discuss in the next few minutes on the information under 147, 148. What is information? Whether there is a reason to believe or not. Now it is made mandatory under 142(1) when it is being forwarded to National Faceless Center. Then the officers have to upload the documents on which they have relied to issue 142(1) notice on the ITBA when they are forwarding the case to the National Faceless Center. Cases under which notices have been issued under 148. Again, Rishabh would discuss this. However, for the purpose of compulsory scrutiny, they have bifurcated it into two parts. Cases post 1st of April 2021, where the cases have been, the notices have gone under 147 after 1/4/2021 under the new law. That would be transferred to central charge. The previous ones would be transferred to NEFC. Cases relating to trusts, right, under 1023C. Now, when will the cases relating to trust come under compulsory scrutiny? There can be various cases when the exemption provided to the trust have been withdrawn, or when the registration of the trust has been cancelled and the trust keeps on enjoying the exemption then it is a fit case for compulsory scrutiny. The list would be forwarded by the assessing officer with the permission, of course, of the CIT, principal CIT, DIT, principal DIT, to the NFSAC marked to the DGIT system. So this would again go to the National Faceless Center. Cases involving addition in the earlier assessments here on a recurring issue. But there is a limit set for metro cities. If the issue is more than 25 lakh, only then it would be forwarded to the National Financial Faceless Center. And if it is non-metro, more than 10 lakh rupees cases would be sent to the National Faceless Center. Again, of course, with the permission of the principal CIT, principal DIT, DIT. Where there is a specific case of information for tax evasion, it will be forwarded again to National Faceless Center. Next is where return, we have discussed this, where return was furnished under 142(1) as a consequence of the notice, then they would not be a case for compulsory scrutiny. For international taxation charges, for the circles where the in case of international taxation, the circles which initiate the scrutiny, they would not forward it to National Faceless Center. The international taxation circles themselves would be doing the scrutiny. So these are the 9 conditions for compulsory scrutiny. Primarily, it is at the department level. However, it does give the information and understanding as to when your case would actually be selected for compulsory scrutiny. Important for tax consultants to know as to when their cases would be selected for compulsory scrutiny, if at all, whether they can be assessed at the circles in or their wards, or will it go to the National Faceless Center or central charge. Few important decisions and few important principles. Now, again, withholding tax under section 195 with respect to Article 12 of the DTA, where it is tax on fees for technical services or royalty is specified. A very, very important condition which is deliberated a lot of times in many case laws, you will see, is make available clause in case of fees for technical services or fees for included services. Now, I'm not getting into what is fees for technical services. Fees for technical services, we know in case of any technical services, engineering, etc., consulting, which you have been rendering, that will come under fees for technical services or included fees for included services. However, under Article 12 of the various DTAs, for example, India, United States DTAs, it is made that this tax would only be leviable in case the fees for technical services is for a technology which is made available. So what is this make available clause? It has been deliberated a lot of times. Let us understand with a small example. In case, say for example, you import a technology, okay, from United States, your service provider is in United States, that technology is to make, say, bricks. Now you take the technology, the engineers from US come to India, they give a training on the technology, and you use that technology to make bricks in India. So the technology is made available to you to make bricks in India, and hence this is a make available technology, and the fees for technical services is for technology which is made available in India. So the root point is that the technology only which an Indian person would be able to apply in India is considered to be make available, and withholding tax would be chargeable on such payments made to a foreigner. You can go through this example which is there in the DTA Article 12 of India US DTA, where this made available clause is discussed in brief with an example. However, in the case of Ironway India Private Limited, the ITAT Bangalore has held that just if you are using a patent which has for which payment has been used, if you are using a technology for searching of payments patents in India, but that would not be considered that you are that technology is made available to you. You are not applying that technology in India to use it for further selling in India, and hence that technology would not be considered to be made available, and the fees for technical services would not be eligible for the withholding tax in India under section 195. Well, a very, very important principle in taxation as a whole, not only income tax, but entire taxation, you call it international taxation, income tax, customs, when you are reading the HSN codes, etc., a specific entry would prevail over a general entry. This has been held in the case of Arkema Chemicals by ITAT Mumbai, relying on the judgment of a Bombay High Court. Now, what was the case? Let us go to the schedule of depreciation under Appendix 1 of the income tax rules. SAP software, when you are purchasing the license of an SAP software, does it become an intangible asset in the nature of licenses under Part B of the Appendix 1, or is it to be considered as a computer software in clause Part A, clause 5? It was answered in the favor of the taxpayer. It is in the nature of computer software, since it is an application software. Since there is a specific entry for an application software, a general entry for licenses would not prevail. A specific entry for computer software would prevail over general entry of licenses, and hence depreciation would be as a computer software, not as a intangible asset under a general entry in Part B of Appendix 1 to income tax rules. Okay, an old unsecured loan, this is something which we face day to day. Old unsecured loan, where even though the credit worthiness and the genuineness has not been confirmed by the department over the last few years, that those last few years assessments are now time barred. Now today the department cannot come up and add that unsecured loan, saying that no, it is in the nature of income, right? Similarly, a old share application money which is there in the balance sheet of a company cannot be added to the income alleging, or cannot be considered to be as an unsecured loan, and the income be considered for the purpose of computing the taxable income of the provider of the unsecured loan or the share application money. Well, we have all read when we are studying income tax, even for our professional exams, that the department cannot guide a taxpayer as to how he should do a business. If there is a share application money which has been provided even by a enterprise to associated enterprise, but it is disclosed in the balance sheet as share application money, it cannot be reclassified or recharacterized by the department and alleged to be unsecured loan, and the corresponding interest be taken in the taxable income of the provider of the share application money. Okay, TDS versus income. Is it important to match the TDS vis-a-vis that year's income? Of course, it is better to match the year in which your TDS is deducted. You should disclose the corresponding income in the same year's ITR. However, there are cases whereby income is taken in the next year, but TDS has been deducted in the current year. It is better in the ITR also, there is a facility to carry forward that TDS. However, what happens when it is just the reverse? You book your income in the current year, TDS is deducted in the next year. It comes in the 26 AS in the next year. Can there be an allegation by the department adding that amount on which TDS has been deducted to the next year's TDS? If you prove that tax has been paid on the corresponding income in the last assessment year relevant to the previous year, that amount cannot be added back. It has been held in the case of Kima India by ITAT Delhi that the nexus between TDS and corresponding income is simply notional. If a assessee can prove that the corresponding income has been taxed in the relevant assessment year, then there is no case for adding back that income in that year in which the TDS is disclosed in the 26 AS. A high level, your faceless assessments, we have many a time seen that there are weird orders. In one such case, we have witnessed that we submitted all the documents pursuant to a notice under 142(1). Suddenly, after 2 days, we saw a 144, a best judgment assessment order. So there are so many high-pitched assessments under faceless assessment where there is the principle of natural justice is not followed or blatant mistakes have been made. This was complained to the PMO to various levels by all taxpayers, and now very welcome step, they have formed a grievance redressal committee. You see, that will be called a local committee for the redressal of grievances. Email ID for high-pitched assessment, for raising a grievance in a high-pitched assessment, faceless assessments has been provided in the circular samadhan.facelet.assessment@incometax.gov.in. If you have any grievance against a high-pitched faceless assessment, you can submit your grievance on this email ID. It would be addressed. However, if you have a grievance on a physical assessment, then you can either write a letter to your principal CCIT or the local grievance committee, or even on this email ID, or both. So this, even under GST, they have formed state level GST redressal committees to which you can complain. So these are important. Okay, voice is breaking. Hello. Is it fine? Yeah. Okay, so grievance redressal, I think I will stop, pause my video. Yeah. So this grievance redressal committee email IDs would be very beneficial for taxpayers going forward. Okay, last small, case where an NRI, wealthy NRI, was getting a gift from a father or a son, then it was considered to be added in the income of the NRI. This was reversed by the ITAT Ahmedabad. Evidences are important in any law, tax law, and not customs. It cannot be said that an NRI cannot get a gift from his Indian brother or father. So there are implications. You have to have evidences whenever you are giving gifts. Then you should have your gift deeds, etc., etc. So friends, this is it from my side on the various important developments. Rishabh, over to you to take forward on this 148 order and the other developments.
Thank you, Priya. Am I audible?
Yes.
So I'll just share my screen. Yes, is the screen visible?
Just a second, it's come. Yeah, it's visible now.
Yeah. Uh, so I will just be covering two topics, and I'll try to wrap it up very quickly within the maybe in the next 20-25 minutes so that we have some time for the Q&A session. And we will try to address as many queries as we can possibly. Uh, we all know that the Supreme Court had passed an order in the case of Union of India versus Ashish Agarwal on 4th of May 2022, whereby it had set aside the 90,000 odd cases which were filed, or the 90,000 odd notices which were issued by the department, against which the High Court at various levels in various states had issued, say, about 9,000 odd orders to say that the notices which were issued under the erstwhile 148 of the Income Tax Act are no longer valid, as the new law had come into the picture, and therefore the assessment or the reassessment procedures had to be carried out under the new provisions of the Income Tax Act. That is to say that notices had to first be issued under section 148A, and then only the AO could go on to uh, assess the or reassess the income under section 148 of the Income Tax Act. The Honorable Supreme Court, in its wise judgment, used its constitutional powers under Section 142 of the Constitution to provide an overruling judgment that the issues which were raised before the High Court were valid, and the points which were given by the High Court were also valid. However, the department had to be given a fair chance to assess or reassess these incomes. And while the department had issued 90,000 odd notices, it was presumed that the department was under the assumption or under the understanding that due to the TOLA Act, there was still time limit which was pending for them to issue the notice. And since public money and the general exchequer was involved, the Supreme Court, in its wise judgment, felt that the department should also be given a fair chance to represent their case, and therefore it passed an order under section 140. It passed an order which stated that all the notices which were issued under section 148 would be deemed that it is a show cause under section 148A subclause B. It also made a one-time exception wherein the department need not follow the procedures under section 148A subclause A. That is to say that it need not follow the procedures for conducting an inquiry before issuing a show cause under section 148A subclause B, and also instructed the department to provide the materials or information which it had relied upon within 30 days from the date of order, that is starting from 4th May 2022. So now the department is under an obligation to provide the materials which it had relied upon to the assessee by 4th of June 2022. Now, while this seems to be a very welcome step, it has also raised some questions, especially what are the grounds which were getting time barred, what were the grounds which are, or what assessments are still alive. This is because the Supreme Court, while passing the order, had said that all defenses which are available either to the assessee or to the revenue under section 149 shall still be available. So if I go to section 149 uh, and read the first proviso to section 149, what that first proviso says, or I'll just take one step back, what section 149 now says is that a notice can be issued for 3 years if the case is below 50 lakh or the income escaping assessment is below 50 lakhs, and up to 10 years if it is above 50 lakhs and it is represented by assets. Sorry. The first proviso to section 149 says that gives a limitation to the department that it cannot issue a notice under the new section 149 also if a notice could not be issued under the old section 149, or if a notice was getting, or if an assessment was getting time barred under under the earlier section 149. Now, this calls for a very interesting observation, as now what has to be seen is that extensions which were given by the TOLA Act from time to time, which finally expired on 30th of June 2021. has to be read along with what are the time limits which were prescribed as per the earlier section 149, that is before its amendment under Wide Finance Act 21, and also the new section 149, whether a notice can be issued as per today as per section 149 of the Income Tax Act. So to comply with the order of the Honorable Supreme Court, the department, the CBDT also in its wise judgment issued a circular dated 11th May 2022, very recently, with the circular number 1 of 2022, wherein it instructed or kind of guided the assessing officer as to how to interpret and how to take the assessment forward. What this circular said is that for assessment year 13-14 and for assessment year to assessment year 15-16, fresh notices can only be issued under clause B of subsection 1 of section 149. Now, clause B is for cases where income escaping assessment is estimated to be more than or is expected to be more than 50 lakh rupees, and it is represented in the form of assets. For assessment year 16-17 and 17-18, what the circular said is that fresh notices can be issued under subclause A of section 149, that is the general time limit of 3 years. Also in the circular, what the department or what the CBDT goes on to instruct the department, and please bear in mind that these circulars issued by the CBDT are a binding on the department, not on the assessee itself. So in para 7.1 of that circular, which stated that for assessment years 13-14, 14-15 and 15-16, if the income escaping assessment for that year is likely to amount to less than 50 lakhs, then a separate instruction will be issued. So if we have to technically or if we have to logically interpret this, is that what the department is trying to say, that for income which is escaping assessment of less than 50 lakh rupees, this circular will not apply until the time a fresh circular is issued. They have to be kept on abeyance. And for income which is more than rupees 50 lakhs, that for those, and so a notice can be issued or the case can be proceeded by issuing a notice under clause B of section 149 subsection 1. Uh, so with respect to this, and for 16-17 and 17-18, it was silent that yes, whatever compliance has to be made as per the Supreme Court order has to be made, which is that the AO has to issue notices within 30 days, providing the information which available with him, which suggests that income has escaped assessment. The assessee will be given 2 weeks time to reply, and the 2 weeks that the assessee will be given will be from the last date of communication of that information. So, for example, if I as an assessee uh, receive a information from the AO and I post my reply asking for some further clarification, and the AO gives me those clarification, the 2 weeks will start from the last date of that clarification which is given by the AO to me. The circular also said that AO can also extend the time limit of 2 weeks because the Supreme Court order said that all defenses available to the assessee would be there, which includes asking for extension of time limit and the AO to decide whether it is a fit case for issue of notice under section 148 after passing an order under section 148A subclause D. Now, the Supreme Court order read with the circular by the CBDT gives some very interesting observations. So now what we have to understand over here is that, keeping in mind the above, the jurisprudence for this is yet to be developed. And in its own wisdom, uh, the wherein the High Court had said that the order of section 148 has to be squashed, since now the newer section 148A has come out. So what the High Court is essentially trying to say is that two laws cannot be present at the same time. When the Tola Act, which had come in on 30th of September 2020, after which Finance Act 2021 had come into picture. So the High Court, to our interpretation, had interpreted it in this manner that when the lawmakers, or when the Parliament, or when the CBDT had knowingly passed Finance Act 21, then the effect of Tola Act to
Rishabh, you are on mute, I suppose.
yes, am I audible?
Yeah. You were on mute for some time.
Oh, so I'll just start with our analysis of the judgment again. So, and sorry for that, the cost of repetition, because I do not know when I went into mute. Uh, so the High Court, to our understanding, said that since two laws cannot exist at the same time, therefore now whatever procedures have to be carried out will have to be carried out as per the newer section. In fact, the Delhi High Court and a few other high courts have gone on to say, while passing their order, that if reassessment can be carried out as per the newer provisions, the department is free to carry out the reassessment as per newer provisions, which again goes on to just prove our fact, or prove our hypothesis, that the interpretation of the High Court which came out was that two laws cannot exist at the same time. Now, the other relevant other relevant point which comes out from the Supreme Court judgment is that all defenses which were available to the assessee will be available, and the Supreme Court has very clearly written this. Now, all defenses include defenses for which have been prescribed in the newer act. The new section 149, as we had just discussed some time back, clearly states that if an assessment is getting time barred, or if a notice cannot be issued under the old law, then a notice cannot be issued under the newer law. Now, these are some of the interpretations which are coming forward from these two judgments as per our. As regards the assessee is concerned, this can also mean that the cases which could not have been opened before 31st March cannot be opened after 31st March per se. Now, again, what is very important in for us to also understand that the Honorable Apex Court in its order in page 7 and 8 has, by very necessary implication, positively approved the inferences of the High Court, as we have earlier discussed. Another very important point which has to be taken into consideration, that the CBDT had also issued a circular dated 10 December 21, wherein after the series of High Court judgments which had come out, they had directed the assessing officers on how to proceed. I'm so sorry. Now, in that circular dated 10th December 21, in para 5 and para 5.1, they have essentially and effectively accepted the legal position that certain assessments are getting time bound because of the first proviso to section 149(1). Therefore, now since they have, and in that circular, nowhere have they spoken about the Tola Act, so they have completely disregarded the Tola Act per se for that circular itself. Now, when the CBDT in its wise wisdom has issued a circular without even considering the Tola Act, and in a way has accepted that some provisions are getting time barred because of section 149(1), now issuing a revised circular by inserting Tola Act is, I think, a re-review of their own, which can again be a challenged, which can again be a ground which needs to be further dwelt upon. Further, so now in the circular which they had issued on 11th May, reintroducing Tola Act without getting time bar dates for assessment year 13 13-14 to assessment year 15-16, it appears like an afterthought, and the CBT should, in its wise wisdom, consider that whether an afterthought can come into the picture or not. Also, what is important, like we were discussing, like I stated earlier, the TOLA Act had itself come into the effect on 29 September 2020, much before the introduction of Finance Act 21. Thus, whether the amendments or the extensions which were applied by TOLA Act have a implication on the on section which were introduced by Finance Act 21, is this something which is there to reply, where we so now what we have tried to do is basically break up the income which is escaped assessment into less than 50 lakhs and more than 50 lakhs as per the new law, and kind of analyze, and please mind this is our own interpretation, and this may not hold, this may not be true as to what the tax authorities consider. So for 13-14, what we consider is that it is a if, and first I would like to discuss cases where notices have been issued for income up to rupees 50 lakh, income escaping assessments up to rupees 50 lakh. That is clause A of section 149(1). So for 13-14, we believe that the notices are not valid, and even if TOLA is considered, the issues get time barred on 30th June 2021. So even if it is considered that 148A can be done and a notice can be issued for under section 148A subclause D, notice under section 148 for reassessment of income cannot be made. Similar is the case for 14-15, assessment year 14-15. For assessment year 15-16, the notices are getting time barred on 31st March 22. Therefore, again, the procedure for section 148A can be made. However, when a notice for section 148 is issued, to our humble submission, they may get time barred. Now, for assessment year 16-17 brings up a very, very interesting reading, because over here, income up to rupees 1 lakh as per the older section 149 will also need to be considered. Therefore, notices will be valid up to 3621 if income is escaping is less than rupees 1 lakh, and it could be issued till 31st March rupees 23. It is getting time barred. For income of rupees 1 lakh to 50 lakh, the notices can be issued up to 31st March 23. That is 6 years time. So since it is not getting time barred, the assessing officers still have the time to assess income above 1 lakh up to rupees 50 lakh for assessment year 16-17. And for assessment years 17-18 onwards, it is a valid notice and it can be reassessed. Now, coming to the next point of where income escaping assessment is more than 50 lakhs. So for assessment year 13-14, our humble submission is that the department can take a plea that income escaping assessment more than 50 lakh may take a plea that since the same was covered by subsection B of section 149 read with TOLA, therefore since the notice was issued prior to 30th June, therefore the assessment can be made and hence may be valid under the newer law. Similar is the case for assessment year 14-15, that it since the notices can be, and this is the view that the department will take, that it is covered by this clause, which we find some merit to as per the present reading of the judgment. For assessment year 15-16, income escaping assessment 50 if it is more than 50 lakhs, and if it is evidenced by the fact that there are some income or some information which the assessee did not submit as per the old section 149, then the department can take a view that the limitation period should be 10 years, and therefore it can assess it till 31st March 26. For 16-17 is the similar situation, and for 17-18 also the situation is similar, that the notices can be valid. So in short, I have basically tried to just summarize what our understanding of these laws are. And as at the cost of repetition again, I would just like to say that this is a view that we have taken and may not be actually subscribed by the department per se. For we are seeing many issues for assessment year 13-14 and for assessment year 14-15, which is less than rupees 1 lakh. The department is which is less than rupees 50 lakh. The department is providing information. Therefore, the view that the department is taking that since the notices were issued within 30th of June, therefore they can proceed. However, this is not in conjunction with the CBDT circular. Therefore, to tackle these notices, what our suggestion or would be that we should always give these grounds that these are the department circulars and these themselves are saying that it is getting time barred or fresh instructions will be issued. Based on that, these should be kept in abeyance till the next circular issued by the department, or we should also proceed stating that this is filed under a dispute, so that later on, in case when we have to say reappeal to the High Court, therefore these grounds can be taken again and a fresh look can be given to the same. Also, what is important for us to understand over here that the Supreme Court had only listened to 2 or 3 of the practitioners, and the rest of the cases were not heard per se. Therefore, the matter may be referred to a larger bench. And what I'm hearing from the department internally is that the department is also planning to appeal the matter to the larger bench because this matter was decided by a 3-member bench. Now, quickly just running through the updated returns. So, as we all know that the Finance Act 22 had brought in a new regime of updated return. For this, they had introduced a new subsection 8A to section 139, which would be effective which was effective from 1st April 2022. Simultaneously, very recently, they had also brought in a new Rule 12 AC, to formulate this new updated return, and this updated return is called ITR-U. This updated return can be filed for assessment year 2021 and subsequent years. Now, what is this updated return? So, for the very first understanding, let us understand who can file this updated return. This updated return can be filed by anyone, that is, who has filed his return under subsection 1 or subsection 4 or subsection 5, or who has not even filed his return and wants to file his return for the first time. So it can be said that for assessment year 2021, this is the last opportunity for us to file a valid return. What are the things that can be rectified in this updated return? If you've not filed a return previously, you can file the return fresh. Income which were not correctly reported can be corrected. Wrong heads of income can be now changed. Reduction in carry forward losses or unabsorbed depreciation or tax credit or wrong tax rate. Friends, it is very important for us to understand that this updated return cannot be a return which is lower than what you have already submitted. No tax credits are allowed, or no refunds are allowed under this return, which is more than the refund of what is claimed or what has been claimed or what is to be paid. So this can only be a return for enhancing your income or reducing the losses or depreciation to be carried forward, and not vice versa. The tax which is to be paid is 25% if it is filed within 12 months from the end of the assessment year. So, say for assessment year 21-22, the time limit is till 31st December. So, within 12 months from the end of the assessment, so if we file this updated return within March 23, then the tax has to be paid is 25%. If after March 23 till 24, if till March 24, then the additional tax will be 50%. Certain cases which are where updated returns cannot be filed is a return of loss. However, if your original return is a return of loss, you can file an updated return to change it into a return of income, but you cannot still file an updated return to as a return of loss only. So say if we have a loss of say 100 rupees in the original return, and now we want to reduce, increase it to say 200 rupees, that cannot be done. But if we want to reduce the loss to 80 rupees, that can also not be done. But if you want to change it to an income of say 100 rupees, that can be done. A return which has the effect of decreasing the tax liability or increasing the refund. Now, an updated return can also not be filed by a person in whose case a search has been initiated or a survey has been conducted, or any person in whose case bullion, jewelry, or valuable article has been seized or requisitioned. An updated return uh, has been, if an updated return has been filed once for an assessment year, then it cannot be filed for another re-filed. If any assessment or a reassessment or a recomputation proceeding is pending, then also an assessing return cannot be filed. Or if the assessing officer has information that the person is has been given notice under Smugglers and Foreign Exchange Act or Benami Act or Prevention of Money Laundering Act, then also a updated return cannot be filed. Or if there is any prosecution, or as per direct tax, as per treaty agreements, if some information has come from a foreign country, then also an updated return cannot be filed. So, this is a very important change which was brought about this year in the budget 22. That, say for example, if for an assessment year, year one you have a loss of 100 rupees, year two you have a profit of say 50 rupees, year three you have a profit of say 100 rupees again. Now, if for year two that profit of 50 rupees is changed to a say profit of 150 rupees, then while filing the original return, we would have claimed a loss of 50 rupees against the income of year two, and the balance loss of 50 rupees against the year three. Since we are filing the updated return for year two, wherein we will claim the entire loss of 100 rupees, therefore the consequential figure or the consequential return for year three also has to be refiled now. And consequently, the section 140B has also been introduced by the department, wherein it provides a calculation mechanism about how to pay the taxes. Now, a quick snapshot into the updated return. Very simple. Part A is general information, that is where you fill your Aadhaar and PAN. Part B, along with the assessment years and whether the return has been previously filed or if it is a first time filing return. Part 7 of the Part A states that if it is applicable, it asks you detail if you've already filed a return to give your acknowledgement number. And Part 8 of Part A states that are you liable to file a return, updated return, as per the first three provisos, or are you an eligible person who can file a updated return. Part 10 asks you the reason why you're filing an updated return. And Part 11 provides whether you're filing it within 24 months or after 24, within 12 months or after 12 months, to determine the 25 and 50% of the tax applicability. Now, Part B is where it says that now it is also important that this return will be a complete return wherein all from ITR-1 to ITR-7 all will be incorporated within. So anyone can go and file it. So Part B, what it says is that it asks for head of income under which additional income is being disclosed. That is from salary, house property, PGBP, capital gain, or other sources. Part B to clause 1 to it says that the ask for the original return or the original assessed income which was provided, and thereafter calculates the liability. Now, what is not clear, and this return, my friends, will be in an online format, but till yesterday evening, they had not issued the utility to file these returns, which we are expecting in a short while. So Part B will compute the additional liability that will be required to be filed, and Part C will require your payment details, and finally a verification which can be digitally signed in case of an individual or a HF by the Karta or the individual person himself, and in case of a corporate, by the person who are eligible or who are liable to sign the return of the company. So with this, it's a basic run through of the ITR-U. Happy to take any question if you may have.
Yeah, so there are few questions. Actually, there is one question in the chat box. We'll take it.
I'll just take that. Many times TDS gets updated in 26 AS on a later date, which is not claimed in ITR. Can we claim it in next year? Yes, we can claim it in next year, as Vivek ji had said in his deliberation. And but we need to prove that the tax for the that period for that income had been paid in the previous year, based on the recent ITR judgment.
Yeah, but here there are two suggestions. One is, you know, it is better if you take it in the same year because it is a case of update. Income is also taken in that year. So maybe you can revise your return if the time is there. And while filing a revised return, maybe if you can carry, take it, if in the next year you are taking it, then there may be a mismatch somewhere and similar issue can happen and then you need to prove it. So better is, I would say, you revise your return if time limit is there. So I think there are no other questions. PPT and recording would be available. Recording would be available on YouTube. Also, Taxguru's YouTube channel, Tax Connect's YouTube channel, and PPT would be sent by us to all the presenters. Thank you very much. See you in the next month's monthly tax updates. Thank you, Rishabh.
Thank you so much.
Thank you, all the participants. Thank you. Over to you, Titli.
Thank you. Thank you, Vivek sir and Rishabh sir, for this wonderful deliberation. Thank you all the participants for attending the webinar. We conduct such webinar as well. We will shortly share PPT and video link to all the participants. Thank you.